Now, how does this relate to technical analysis, which seems very much sort of its own topic? Well, remember, technical analysis is the idea that we can infer predictable return patterns from past price data, whether from volumes or from price trends. And what this has to do with behavioral finance is that essentially technical analysis supposes that not only are markets irrational, but they're also predictably so. In other words, what technical analysis exactly tries to find is trends that will persist into the future, resulting in return predictability while the trend continues, and potentially leading to reversals, which then also result in opposite predictability when a crash follows a trend. And also being able to uncover this sort of idea of investor sentiment that might be at the heart of some of these behavioral biases, and therefore may offer indicators of return predictability of either assets that people are euphoric about or irrationally pessimistic about over the future. In other words, if prices can give us an insight into sort of the irrational mindset of investors, then perhaps we can use technical analysis to actually create these indicators of return predictability. But of course, this is very much in contrast with efficient markets hypothesis, because remember, even the weak form of efficient markets suggests that certainly prices can't tell you anything about predictability of future returns, but also with the rational underpinnings of portfolio and asset pricing theories. So what types of technical analysis actually is out there? Well, we've sort of talked a lot about the importance of momentum, even as a rational asset pricing risk factor, but also as something that could be driven by behavioral biases, things like prospect theory or the disposition effect, where you don't want to sell your losers and you hold on to your winners, producing an underreaction that leads to momentum. So how do we actually measure momentum such that we could potentially use it as a trading signal? Well, one simple way to do it is just look at the moving average. Most commonly a 50-day moving average, and just see whether the current asset price has risen above the 50-day moving average. That would be a bullish signal for positive momentum, or whether it has fallen below a 50-day moving average, which would be a bearish signal indicative of negative momentum. So in other words, once the price crosses the 50-day moving average one way or another, historical data suggests that there's higher likelihood of that continuing. And that, of course, is very much consistent with the other findings on momentum, which essentially is just that momentum is a phenomenon that continues for some time. Winners keep winning, losers keep losing. It's just sort of a matter of how long that could be expected to persist. Now, another way to measure momentum is relative strength, where you essentially look at changes in the security price relative to an industry price index of perhaps similar firms. So if this particular security we have in mind, let's say how a company starts appreciating more than other same industry firms are appreciating at the same time, that would be an indicator that there's some sort of higher enthusiasm or good news, or just generally greater momentum in our particular security relative to the rest, and that might then also be expected to continue for some time down the road, resulting in this momentum-based return predictability. And similar, but in terms of its name, the relative strength index doesn't actually have very much to do with the relative strength, but also is an indicator of potential trends and especially reversals. It's what's known as an oscillator, which is essentially just a normalized indicator ranging anywhere from 1 to 100 that gives you sort of a measure of how, using moving averages on the uptrend, moving averages on the downtrend, how often in the recent past the security has been moving up relative to down or down relative to up. And in general, the higher the value of this oscillator, the more it has recently been moving up. In other words, the more it has recently had positive momentum. And if it's sufficiently low, that would be indicative of recent negative momentum. And we can think about this in terms of somewhat arbitrary, but guided by past data thresholds. 70 and 30 are commonly used values for this type of oscillator, where if the value is above 70, that stock is considered to be overbought just because it has gone up continuously far too much without ever going down in recent history. A common window over which RSI is measured, relative strength index, is perhaps a couple weeks. And if it has been going down over the past couple of weeks without ever appreciably rebounding up, that would be an indicator that there's too much negative momentum, it's oversold. So once it reaches one of these values, that would be an indication of a trend reversal. And we can actually look at some price charts and actually see to what degree we might casually infer some credence for this. So here's the S&P 500. We do see that if the 50-day moving average is the smooth line in orange, we see that some cases where the price of the S&P index has moved above its 50-day moving average. Indeed, that does seem to be the beginning of an uptrend, such as here and here. And indeed, when the price dips below its 50-day moving average, that can be the beginning of a downtrend. But at the same time, there are other cases, such as when it crosses here or here, that don't necessarily seem to signal a long, stable uptrend. And if we look at the RSI, in this case, indeed, a 14-day moving average, that seems to indicate overbought and oversold conditions, especially well around the March collapse in 2020 of the S&P index and its subsequent recovery, where we can see that it has been very persistently overbought for quite some time, pretty much right before the February-March crash. And then that led to it being oversold, which then perhaps explains the subsequent rebound. But that said, there's also periods where it traded at a really high RSI, indicating overbought conditions back in 2019 without appreciably crashing. And it was oversold potentially in 2019 without necessarily starting a very meaningful uptrend. Whenever the RSI would hit that oversold level of 30, that didn't necessarily mean that a new trend a trend reversal was going to take place. So all of these indicators are useful, but they're more heuristics of trying to infer these underlying psychological patterns from price data. They're not laws by any stretch of the imagination. Another commonly used approach is Bollinger Bands that can actually tell you quite a few things about trends and volatility. They're essentially standard deviations above a simple moving average, again, sort of backward looking, and they're useful in terms of getting a sense of price extremes, as well as periods of high and low volatility. But importantly, remember, since this is a backward looking moving average, since all we have is historical data, it has to be backward looking. and historical volatilities, this is really just a measure of ex post volatility. But the way that the Bollinger Band is constructed is essentially we take a moving average of the price over some days, 20-day moving average is a common one, and we take a band around it of some number of standard deviations of price relative to the moving average. A common number is 2 standard deviations above and below the moving average. And if we plot that for the same window of time for the S&P index, here's the sort of thing that we can learn from it. We can actually see the bands through time. The purple is the upper band, moving average plus 2 standard deviations. The green is the lower band, moving average minus 2 standard deviations. And we can see that if prices are sort of at the extreme of, if they hit either the lower band or the upper band, it often signals a reversal. So indeed, during the March crash, prices were very much hitting the bottom of the Bollinger Band, indeed for quite a few days in a row, but eventually they rebounded off it, and then they hit the top band and rebounded off of that, and then they scraped along the upper band for a while and then rebounded off it. So essentially the Bollinger Band can give you an indication of when prices are becoming a bit stretched, when they're about 2 standard deviations above the long-term moving average, which can then be an indicator of an upcoming reversal. So we can actually see where the price is currently relative to the overall bandwidth. I guess that would be 4 standard deviations, 2 up and 2 down relative to the moving average. So we can see whenever it is actually falling below or outside at the lower band, that would have a negative value, and then sometimes when it would be scraping above the upper band, it would have a positive value here. That would be indicative of perhaps an upcoming crash, and indeed there is a downturn in prices, and then it starts hitting the lower band again, which would perhaps be an indicator of a rebound. So you can see how prices generally actually will bounce around within this 2 standard deviation channel. And this is, of course, why, remember, the 2 standard deviation idea is just sort of an ad hoc rule that people often use in implementing this indicator. It just sort of seems that that captures most price action within 2 standard deviations of the 20-day moving average. So when it does hit the upper band, that is often an indicator of an upcoming price reversal downward. When it hits the lower band, that is often an indicator of an upward rebound, as we see in prices, but not always. So for example, sentiment was seemingly over positive and that prices were scraping the top of the Bollinger Bands in June, and there was a minor reversal, but there never really was a crash. So again, these indicators have to be taken with a grain of salt, but they can be informative. And the other bit of information that you can learn from the Bollinger Band indicator is just how volatile the current period is, at least based on historical volatility. So when there are big price changes, big deviations from the moving average, we see, of course, the bands expand, because remember, they're a fixed coefficient of the volatility of prices relative to the moving average. So when prices change, 2 standard deviations becomes bigger, because each standard deviation is now greater. And we see that especially during the March crash, those bands became quite wide indeed. But that's in a way a good feature of this indicator, because then it just takes an even bigger price movement to hit one of these 2 standard deviation bands and signal potentially even more overstretched market conditions. Again, not a foolproof system by any stretch of the imagination, but if you sort of look at the oscillation of prices in this channel, it seems at least superficially credible in the sense that, yeah, prices generally do bounce around in there, and when they hit the upper limit, the upper band, they often then will, at some point, fall and then eventually end up hitting the lower band. The problem, again, to making trades based on this is fundamental risk, how long you can sustain the trade moving against you before it actually does move the way you expect, and model risk. Is this indicator actually fully reliable? Breadth is a much simpler indicator, essentially just a measure of how many stocks on a given day are advancing versus how many are declining, and that gives you a sense of how strong any particular trend is. So you can literally just count up on a given day how many stocks went up on an exchange like the NYSE, how many stocks went down, how many went up in the NASDAQ versus how many went down in the NASDAQ, and then therefore what is the ratio of the two. Higher breadth, if more stocks move one way or another than the opposite, means a stronger trend. So, for example, if the market rises but very few shares out of the whole index are rising, well, that means that whatever index rise is really being driven by a small number of shares. That means the trend is likely very weak, because all it takes is some bad news in a couple of firms to reverse it. Whereas if the market rises and a lot of the index constituents will rise along with it, that probably means that that trend is much more durable, simply because it'll take something truly systemic to reverse the trend in so many different stocks. So higher breadth is an encouraging signal of trend persistence. And analogously then, if breadth is low, that can be a sign for worry. So here, for example, is a chart of cases where breadth has been fairly low in the market, but the market has advanced. Indeed, about, let's say, less than a third of the S&P 500 shares have gained, but the index still advanced. You can see that this happened quite a few times in 2003, sometimes in 2010, sometimes in 14 and 15, and quite a bit in 2020. And historically, this has reflected several things. Either a rally that eventually stalls and peters out, like a post-bear market rally that after the dot-com boom that, well, doesn't really end up going anywhere. A bubble, such as in 2000 and in 2008, or some sort of transient growth scare like in 2014, 2015, where the market simply takes a pause. But at bottom, when an advance happens in the index and breadth is narrow, in other words, not too many shares are actually, or not too many index constituents are moving up, that's a worrying signal. And related to this is this idea of the trend statistic, which essentially also tries to infer breadth. You can essentially take the volume of declining shares relative to the number of declining shares, therefore getting like an average volume per declining share over the volume of advancing shares relative to the number of advancing shares, average volume of advancing shares, therefore. And if you see ratios above 1.0, that's an indicator of an upcoming or even current bearish trend, because there's more shares per stock that are declining than there are advancing. Now, in terms of sentiment, we can look at sort of certain measures of how investors are behaving to infer how optimistic they are and Some of these momentum indices do this as well, but one sort of long-standing measure is a confidence index, where we look at bonds, the yield on some highly rated corporate bonds relative to the yield on less highly rated corporate bonds, as an indicator of investor sentiment overall, and therefore this is an indicator that comes from the fixed income market, but might have explanatory power for sentiment in the equity markets as well. The reasoning is that, well, a higher value of this spread or this ratio is probably optimistic, right? If investors are actually willing to buy more of a high-risk bond, that means that its yield is going to be lower, right? So remember, this is a ratio of yields. And we can broadly think of this as the yield on safe bonds. Remember, these are corporate bonds, so even top-rated corporate bonds aren't risk-free, but they're considered safe, divided by the yield on risky bonds. And intermediate doesn't necessarily mean junk, but it means that there's more default risk. So if a higher value means that the yield on safer bonds is, well, going up relative to the yield on risky bonds. Of course, the yield on risky bonds is always going to be higher than the yield on safe bonds, but that ratio in going up means that generally the yield on risky bonds is at least falling relative to its prior level, which means that the price of those risky bonds must be going up. And if the price of a risky bond is going up, that means that investors are generally becoming less risk averse. In other words, they probably would then be also more comfortable paying more for risky equities. And this is also similar to a credit spread as a macro indicator, where you could look at the difference in yields between safe and risky bonds. That would then also tell you sort of how comfortable investors are at any point in time. In general, the closer the two are together, the more comfortable investors are. The farther they are apart, the greater the yield on risky bonds relative to lower risk bonds. The more worried investors are, the less confident. And related to this, another signal from yet another market is the put-call ratio in options. Why might this be informative for investor sentiment broadly, even as it relates to equities? Well, remember, call options are the right to buy an underlying asset, so buying calls is a bullish position, a way to bet on prices rising. Puts are a right to sell, and therefore it's a bearish position, a way to bet on falling prices. So if you observe, let's say, more puts being bought and sold than calls, that may signal more investor pessimism in a coming market decline, simply because it means that there's more people who are willing to take the bearish position than there are who are willing to take the bullish one. So the put-call ratio, literally just a number of puts to calls either being sold in terms of volumes or held in terms of open interest. If there's more and more puts being traded, well, that means that somebody is becoming more bearish, at least relative to current levels, and at least relative to the people who are being bullish by wanting to trade calls. But of course, remember, since an option has to have two parties, somebody to buy and somebody to sell, this may actually mean that it could be a contrarian signal as well. because perhaps rising put-call ratio is simply due to the fact that some investors are more comfortable selling puts to counterparties because they actually don't think the market is going to fall. So even this ratio is also somewhat ambiguous. But generally, more put option activity indicates at least concerns about turbulent times ahead. So with all of this, there's an important caveat, which is that, as we saw with the discussion of overconfidence and behavioral biases, it's actually really easy for humans, just sort of given our bent toward finding patterns, to spot patterns where there aren't any. And this is a famous example that we're looking at here, where if experimental subjects are actually shown what is described as price data, they might actually read all sorts of patterns into it, even if it turns out that one of these is completely simulated and therefore never contained any information about anything by design. The sort of willingness of an investor to read a pattern into something generated by an algorithm that doesn't actually have any information about, market trends, optimism, valuations, or the future prospects of a firm, simply because there is no firm that these simulated price paths would be describing, well, it sort of indicates the propensity of investors really to be subject to overconfidence bias. And at bottom, really, the sort of exercise of generating predictive signals with technical analysis, just like the generation of any other predictive signals from fundamental analysis, from alternative data sources, is sort of negotiated at the tension of data mining. In other words, just trying to find patterns in data where some of those patterns may be spurious, against model validation. In other words, checking your findings and trying to make sure that they are robust. And there are statistical ways to do this, and in a way the truth may be out there. For example, Renaissance Technologies, which uses signal processing, though they are famously secretive about their investment processes, that seems to be where their investment expertise originated, may well be using these sorts of indicators from price and volume data to actually trade incredibly profitably on. But that may simply mean that their model validation abilities are equally strong and able to match their data mining abilities. And if all one does is uncover patterns but not test them, then it's really easy to mislead oneself and make trades based on things that aren't actually there. Thanks for listening.